I did participate in the 5-year TIP auction today, April 18th. TIP simply is an abbreviation for Treasury Inflation Protected Note. I will not be discussing that purchase in my blog, which I will publish tomorrow. The coupon was 2.125%. The TIP was sold at a discount to par value that slightly raised that yield. The principal amount of the TIP will be increased or decreased by the amount of CPI every 6 months, and then the coupon of 2.125% will be applied to the adjusted principal amount. I view the 5-year TIP to be an alternative to purchases of I-bonds. The reason is that the I-bond has to be held at least 5 years to avoid forfeiting 3 months of interest, and I'm not going to forfeit 3 months of interest. The real yield on that 5-year TIP is superior to the 1.3% fixed rate on an I-bond purchase made between now and prior to May 1st, 2024. The Treasury will announce a new fixed rate for I-bonds purchased on 5/1 and prior to November 1st. I bought 5,000 in I-bonds in 2016 when the fixed rate was just 0.5%. I will be selling those after I have held them for 5 years, which will be sometime in June, and will simply use the proceeds to fund living expense. One advantage of the I-bond is that interest is not taxable until the bond is sold or ownership is otherwise transferred. I will buy those in my Treasury direct account from time to time. I buy the TIPS in my Roth IRA brokerage accounts. I do not buy those in my Treasury direct account. I do not pay a commission on any Treasury purchase, either at auction or in the secondary market, in my Schwab, Fidelity, and Vanguard brokerage accounts. The inflation accretion to a TIP principal amount is taxed as interest each year, even though the TIP is not sold. That is one of the reasons I will not buy them in my Treasury direct account, which is a taxable account. Since I am philosophically opposed to paying a tax on interest that is not actually realized, I will own TIPS only in my Roth IRA accounts. Intermediate and longer term Treasury yields have been trending up this month. That is in response to some recent inflation reports that show month-to-month increases in inflation that are trending higher, and the annual increases are proving to be resistant to moving lower. The 2-year Treasury note will be auctioned on Tuesday, April 23rd, and I've decided to participate in that one, though, with a small purchase. The yield is currently near 5%. I've already entered an order to buy the 6-month Treasury bill that will be auctioned next Monday, and will probably buy the 4-month bill that will be auctioned next Wednesday. I will not be buying the 3-month Treasury bill this week. The yields for the 1-month to 6-month Treasury bills have flatlined into a slightly higher range than earlier this year, at the current range being 5.39% to 5.52%, with the 2-month Treasury bill closing today at 5.52%, the highest Treasury yield throughout the maturity spectrum, 1 month to the 30-year bond. The 2-month and the 1-month Treasury bills are auctioned on Thursdays. The 1-month to 6-month Treasury bill yields are above the midpoint of the current federal funds range of 5.25% to 5.5%, signaling an investor consensus at the moment that the Fed will not cut the federal funds rate before the September meeting. Any future prediction can be off, of course, and subject to change based on future developments. In my post tomorrow, I will be discussing adding 17,000 in Treasury bills and 12,000 in very short-term investment-grade corporate bonds. Both of those amounts are in principal amounts. That is close to what is a normal purchase for me during a week. My bond ladder has a constant stream of maturities each week, and I need to figure out as they come due what I'm going to do with the proceeds. All of the short-term corporates were bought at below par value, as I said, and mature between April 15, 2025 to September 2025. I'm cutting off my discussion of those purchases made prior, with purchases made prior to Wednesday. I've been purchasing a fair amount today and probably will tomorrow. I'm picking up about 0.5 to 0.6% in yield in those corporate bonds that I would receive from a Treasury purchase. It wouldn't make much sense to take even the small credit risk for that yield if I had to pay a state income tax on the corporate interest. Since I live in Tennessee that has no state income tax, I don't have to take that into consideration. So I'm able to generate slightly more income. Maybe over a year it amounts to $5,000 to $8,000 in extra interest income from the corporates compared to investing the same amount in the treasuries. I increased my stock allocation this week by over 1,600 buy and dividend paying stocks, but that does not move the needle at all. The stock allocation on a total portfolio basis remains at below 12%. I am nibbling mostly on bond-like stock sectors like real estate investment trust, where the stock prices have reacted negatively to the recent rise in intermediate and longer-term interest rates. I will be publishing the post tomorrow.